Hi everyone, I'm Tom Wilson. I'm the Investor Education and Product Specialist at InvestSMART. Welcome to the webinar, Where's the Best Chance for Outperformance? So today we're thrilled to have two valued panel members with us who are going to discuss the brand new Intelligent Investor Select Share Fund, and that has the ticker code of IISV. So our first panel member is Nathan Bell, the Portfolio Manager of the Intelligent Investor Select Value Share Fund. And he's got years of experience managing investments across various markets. Our second panel member is Nick Cummings, an analyst at the Intelligent Investor, who's got extensive global economy knowledge, provides valuable insights into the international investments. We provide general product advice only, not any type of personal financial advice. And we're going to upload the webinar to the website at the end of this live session. But that's enough from me. Hi, Nick. Hi, Nathan. Welcome to the webinar.
Hi, everyone.
Thanks, Tom. So this morning, we're going to talk about the genesis of the fund, why we're doing it, a bit about my background and why this idea has been over a decade in the making and the product of 16 months of hard work. Nick's going to take you through a few stock ideas just to give you a bit of a flavour for the sort of companies we want to own in this fund. I'm going to talk about some of the features of this fund because it is a unique fund, and even just the fact that it's mostly international stocks makes it very different to our other funds as well. So I'm just going to, you'll be able to get a copy of this slide deck later on, but I just want to skip straight through a lot of the marketing guff and do my own sales pitch basically. So if I can get one key message across for this fund for people is that there are lots of reasons why I really believe people understand the potential of investing overseas, but they just find so many reasons not to actually do it. You know, it's complex, there's so many stocks to look at. They look at a lot of fund managers and don't recognize any of the names. There's that complete lack of familiarity. There's these strange esoteric names and places where the funds invest, and there's currency risks that people worry about. So there's all these things that have stopped people from investing overseas. But I actually think people are now more open to it than they've ever been in the past, and that's for a bunch of reasons. And I pick on the banks a lot, but just to make a really important point, the three of the big four banks, despite a massive credit and housing boom over the last 10 or 15 years, their share prices are still the same today as what they were in 2006. So that's a big chunk of the market where 17 years you've gained no capital gains. But for the people who have been lucky enough to own companies like CSL and ResMeds and these great global winners, the returns have been incredible. And that's what we've really built this fund for. It's for people who understand the benefits of investing overseas, but want something that's very easy to do and something that they can go to bed each night feeling very comfortable that they own a portfolio of absolutely exceptional companies. So my mandate for this portfolio is really to buy once and buy right. And if we select the right companies, then we'll never have to sell them. And that means your money can grow, without getting the compound. You can't get cut short by crystallizing capital gains or anything like that. Now, obviously, we're going to be turning over the portfolio somewhat to get into the best ideas, or things don't work out. All the same problems of investing in Australia apply overseas. But this is a really exceptional group of high quality businesses where you're not going to have to worry about owning esoteric stocks in China. Believe me, there's nothing that upsets a good night's sleep than owning stocks listed in China. This is not that fund. This fund is really just nuts and bolts quality. And I think people who have followed our subscription business for a long time have seen what happens with each cycle. We run out of good ideas because they're just so few elite companies in Australia, and we end up recommending some spec buys to keep people interested, and even though they're well ring fenced, they fare really poorly, and our track record with quality companies is exceptional, but with low quality it's terrible. So and now we've got a lot of experience on the team which we've never had before, which has really been boosted by bringing Nick on. It's been a great acquisition for us, and Gorav's certainly taking the claim for bringing Nick on, and he deserves every bit of it. And Nick's done most of the work, even though it's been a team effort, and has done an extraordinary job over the 8 months or so since he's joined us. So we're really excited about launching this fund. It's been, as I said, over 10 years in the making. But for me, it's really a lifetime of investing experiences wrapped up in this fund. People ask, what do you bring to international markets? Why are you going to succeed? And the sad answer for them is we don't actually know anything about these overseas stocks that anyone else doesn't know. In the same way, we don't know anything about Australian stocks that anyone else doesn't know. The fact is, we just bring a long-term view, a contrarian streak, and lots of patience. And so what we want is a portfolio full of CSLs that aren't weighed down by a bunch of banks that aren't producing any capital gains, highly cyclical iron ore miners which produce great dividends, but China's doing everything it can to remove its reliance on those businesses. A-REITs are another big chunk of the index, very little growth and no franking on the distributions. And then you've got something like CSL, which is about 7% of the index. So all of that is about 75 or 80% of the index, and those rare companies like CSL always trade at nosebleed valuations. So it's really hard to find those great businesses at great prices, and that's what this fund is all about. So that's the reason behind the fund. In terms of key fund features, obviously it's going to be somewhat different to our other three funds. One quick one, a lot of people are asking whether it's going to own the same stocks as our growth fund, because the beauty of this fund to me, and this is really, really important, is that I've been watching international fund managers for a very long time now, and the best performing fund virtually always, for the few fund managers that have these mixed funds where they can own overseas stocks and local stocks, is that mixed fund is always the best performing, and usually by a long, long way. Funnily enough, some funds are international funds with a few local stocks, which is what this fund is. And there's some others which I see are called the Australian Fund, but they have a whole bunch of international stocks in them. And I always wonder why those portfolios are doing so much better than some of our Australian portfolios at times, and it's simply because they're not Australian portfolios. So that was really the genesis of the idea. It's just the best way that I've seen to outperform through all my experience is when you can buy the best of overseas and the best of Australia. With this fund, one key difference is it's probably going to own more stocks than what we've typically got in our existing Australian funds. So we tend to have around 20, 25 at most usually in the Australian funds. With this one, at the moment, we've got around 30. And the reason is because we can actually own more great quality businesses without hurting the potential upside for the portfolio. So in a sense, we're reducing risk, but at least maintaining what we think the returns can be. So that's a great win straight up. As I've said there, theoretically, it should be our lowest risk fund. Now, I don't know whether if you calculate the statistics on the variance of the portfolio over time, I don't know whether it'll be any different. Usually it's pretty similar. But in terms of the quality of the business, it's basically chalk and cheese, because there just aren't 25 elite companies that we can buy at any one time in Australia. There's probably not even 25 elite companies, yet alone trading at a decent price. And because Australia is one of the most competitive, if not the most competitive investment market in the world, because we have such an educated bunch of people following the market. We have so many professionals, so many financial institutions, and we've probably got about a dozen great businesses, and it's just so rare when you actually get a great opportunity to buy them. So they trade at these big premiums, because they're unique. Whereas, you go to America and these businesses aren't so unique, and there isn't 12 of them, there's 50 of them or more. And also there's just different cycles around the world. Just for example, I bought Bank of Ireland myself at the start of the GFC. This was a bank that was basically all cleaned up since the GFC, but a couple of things that were overhanging was, one, the margins were getting crunched because the official European Union central bank interest rate was negative 0.4%. So that was crushing bank profit margins. And the Irish government still had a big shareholding in the bank. So COVID came, share price went down below €2. Turn around today, no government shareholding overhang, interest rates going up, margins fattening massively, and Bank of Ireland never had the issues that you have with the Australian banks, where you've got this, hugely, I think it's risky, mortgage market where people are leveraged to the hilt, and mortgage debt was extremely low in Ireland, and there was a shortage of homes. So it ticked all the boxes, and that stock is now €10. So you've made more than 5 times your money in 4 years from a bank. So that's just one example of the different cycles we want to take advantage of around the world. The chief currency exposure for the fund will be the Aussie dollar versus the US dollar. And I know, we've seen this already, lots of comments with the articles on our website about, I'm only buying international stocks when the Aussie dollar's at 80 cents or something like that. Nick's going to talk about MasterCard, and in 2006, when it listed, it was a $5 billion US dollar company. So that's actually considered a small cap in America, which is pretty amazing. This company had 40 years of history, and everyone knew this was a great business. And at the same time, you could have bought any of the three of the big four banks, not including CBA, or you could have bought MasterCard. Since then, you've had zero capital gains from those three banks, zero. And yet, I bet if I asked an Australian investor, would they pick one of those Australian banks or a bunch of them, or MasterCard, I'm sure 99.9% of them would have went for the banks. MasterCard's gone up nearly 100-fold. So it's just absolutely chalk and cheese, and you're far more likely to find a business that can go up 10, 20, 30 times in the States than what you are in Australia. For all of America's problems, it's still the place that people want to list their businesses. It's still the most entrepreneurial country in the world by far. And we want to just take, basically we just want more of what we really want in Australia from overseas, where there's just a lot more of it. It's just as simple as if you want to catch a fish, you've got to go where the fish are, and there's just a lot more there. We've got a performance fee on this fund. People have heard me talk about performance fees before, and how for a small fund manager like us, I think it's been a big mistake not to have performance fees on our other funds. If you want to attract and maintain talent over long periods of time, you've got to be able to reward them. And we haven't been doing that currently, despite the great performance of our funds at times. So we're taking our first step and putting a performance fee on this fund, but it's what I call a no BS performance fee. So to give you a couple of examples, let's say in the first year, we get the portfolio goes from 100 to 120, the market only goes up 10%, not 20, and we get a performance fee, and everyone's happy. We've got great outperformance, we earn the performance fee, and happy clients and happy staff and a happy business. And then the next year, we have a terrible year and we go down by 50%. So clearly we're not going to earn a performance fee then. Then the next year, we make another 20% and the market only goes up 10%. So we've outperformed again, but we cannot earn a performance fee at that point because we've got all that ground that we lost the year before to make up. So that's what they refer to as a high watermark. And there are a bunch of funds in Australia that do not have those high watermarks. And so they have these awful, awful years where they're swinging for the fences and they blow up. And then the next year they outperform and then they charge this massive performance fee. So we're not doing that. We're not scumbags. We're not greedy about this performance fee. This is just all about trying to create a sustainable business for the long term. And so the second example I've got is, and I think this is one that people don't understand very well either, is this RBA cash rate. So to give you an example, let's say we lose 30% one year, but let's say the market fell 50%, so we actually outperformed by 20%. And obviously you're not going to be happy because we've lost 30%, but at least we've done far, far better than the index. Well, we cannot charge a performance fee for that. We have to have made a return ahead of the RBA cash rate. So we have to have made you money if we're going to charge a performance fee. So if you add those things up, basically we cannot charge a performance fee unless the fund is reaching new highs, and we have to have made you a positive return in a year. And if you put that together, that's to me is what we call a no BS performance fee. And if investors in the fund have to pay a performance fee, believe me, you're going to be happy with the returns. So this is just a way that I believe where the rewards are shared more equally between the business and the investors, because it's absolutely great that our investors have done so well with our other funds, even though they haven't been doing so well lately. That's great. We want happy clients. That's what our business relies on. But as a client, as an investor in our funds, you want a sustainable business. You want to make sure that the team's sticking around for the long term, because there's nothing worse than the team breaking up or losing talented people, and it's harder than ever to find people. And that's why we're so happy we've got Nick on board. So that's why the performance fee's there.
I was just going to say, Nathan,
sorry,
just to give you a chance even to get your breath back and everything. In the group chat for the webinar here, I've actually put on the link to the help center, and it does have another explainer of the performance fee, because that's something we get asked a lot about. But just to summarize, there's the two hurdles, which are the benchmarks, the ASX 200 accumulation index. So that's dividends reinvested. And then there's, as Nathan said, the RBA cash rate. So those are the two hurdles, so to speak. But then there's that high watermark. So there's an explainer on the help center. But yeah, hopefully that helps as well.
And so the corollary question in regards to the performance fee is, why are we using the ASX 200 as the benchmark? And it's very simple. Firstly, the ASX market is the highest performing market in the world. So I wanted to set the bar as high as possible. So that's the first reason. And the second reason is, if you can't beat the ASX 200, then why bother investing overseas? So that's the benchmark, very simple. This small cap liquidity bucket, people will have heard me talk about this before, but for anyone new, our funds are all actively managed ETFs, so they're listed on the ASX, and you can obviously participate in this raising, or you can buy units just like you buy any other share. But because of this, we have to abide by the ASX listing rules, which means there's a certain minimum of small caps we can have in the portfolio. So it's roughly no more than 20% of the portfolio in stocks with a market cap of less than 500 million Australian dollars. But actually it's much tighter than that, because there's a whole bunch of liquidity rules as well. So I don't want to be mucking around in international markets in sub $500 million stocks. It's just too illiquid, and when the markets aren't open at night, I don't want to wake up and find some minnow stocks down 30%, and then I have to set the trades for the next night, not knowing what it's going to look like. So that is going to be reserved for our favourite small cap stocks in Australia. So think of RPM Global, MA Financial, Frontier, I'm sure there's a couple of others. So that's really what the Australian exposure is going to be. So that's why this fund will look very different to our growth fund. They'll only probably have about 10 or 15%, maybe 20% max in common. So if you own one, you can happily own the other, and know that the correlation is not going to have anything to do with the stocks in the portfolio, because this fund is going to be, at the moment, it's about 80%, and that's what we expect it to be over the long term. And obviously it'll just swing around a little bit depending on where we're finding the most value. The last couple there, I've already talked about the guiding principle of buy once, buy right, which I think, if you're listening to this webinar and you follow Intelligent Investor, you know what that's all about. The last couple of points there are really more for me as much as anything. These are the things that get me excited and what I really want to find. So we still need to make the downturns count, and we've got a really good track record of making the most of downturns. So when we do get those broad buying opportunities, we need to make those count with this fund as well. And what we might see whenever we do have one is that we might concentrate the portfolio a bit more at that point, but we don't need to at the moment. And the one that, this is probably the most exciting thing, I think, just as an analyst, just as an individual investor, is just trying to find the winners of the next decades early. I'll quickly talk about a stock I bought myself during COVID, and I didn't put a lot into it because I didn't have much money left after buying a whole bunch of other stocks. And the company was called Celsius, and it's a drinks company. So think of a healthy version of Monster energy drinks. And I bought it at about $3.60, and I sold most of them at $60. Obviously did way better than I ever expected, but because I didn't have a whole heap of money in it, that's why I'm still here. And that stock went to $120 and currently sits around $90. So this is it's been an extraordinary story. It's still very, very in the company life cycle, but you just don't get those sort of businesses in Australia, and you certainly don't get them as regularly occurring as what you do in the US. It's just, the US is just a bigger market. It's really the center of the financial universe, and I don't think that's ever going to change, and certainly won't change in my lifetime. So again, we just want to go where the fish are, and if we make those downturns count, we've got a small advantage, I believe, in the long-term investing approach and being patient. That works in every market around the world. That's what sometimes there is, especially to know about the individual stocks, but that's just part of the research. This isn't rocket science, but we bring that long-term view, we be patient, and we get lucky with finding a few winners, and maybe even getting a few companies out of bankruptcy, which is, for anyone that is familiar with Peter Lynch, turned out that his 29% a year for 11 or 12 years or whatever it was that's so famous really came out of 2 stocks that came out of bankruptcy. So there's like another aspect of the US market that you don't find in Australia. So they're things I think about, and obviously as an investor you don't need to worry about that stuff. That's what you're paying us for, but that's what gets me excited about this particular fund. I've taken up enough time now. I'm just going to quickly go through some of these talking points because I know people have brought these questions up, so hopefully I'll answer a lot of those questions, but maybe it prompts people to ask some different questions. So I've already talked about the first couple. You know, you really don't want to think about exchange rates. We can hedge in this fund, so if the Aussie dollar gets too far away from the long-term average of the US dollar, which is around sort of 73, 74 cents, then we will hedge the currency risk. We don't necessarily want to be doing that because it costs money and you've got to hold a little bit of cash against that when you want to hedge your currency. But you know, at the moment the Aussie dollar's at 66 cents, so we'll probably do a little bit of hedging. We'll definitely do at least some. Again, I just described how it's easy to find huge winners in the US and Australia. I don't want to make out that investing abroad is any easier than what it is in Australia either. It's just as hard. But you just have a lot of tailwinds on your side buying a great business, buying a portfolio of 30 great businesses compared to when you know, maybe you own 10 in Australia and you've got to fill out the other 10 or 15. And I've got an example there. A mate of mine got offered shares in Xero at 78 cents before it listed in 2007. And you compare that to MasterCard, and I know I'm cherry picking here, but I'm just trying to make a point that MasterCard, when it listed in 2006, it had been around for 40 years, and you knew what a great business this was. It was one half of a duopoly. Whereas Xero was just, you know, it wasn't the more obvious big winner it is today after the stock's gone up 100 times. It was actually much more difficult to predict. It, you know, it didn't have the big revenue. In fact, I actually read that they couldn't even raise $18 million when it listed. Unbelievably, that's how low the expectations were for the business. They only raised $15 million, and you see what it's come to today. But you know, you're just so much more likely to find a MasterCard in the US than you are to find the next Xero. Next line there just says, you know, Nick in particular has brought a whole bunch of new stocks to the team over the last 8 months, and it's impressed the team so much that this fund will be the most supported fund internally, which is a feather in Nick's cap. That's great, but as for you as an individual investor wondering what to do with your money, you know, it's all well and good to have staff investing in the fund, but all you should care about is outperformance. That's it. If you don't think we can outperform, then please don't give us money. I've just talked about Peter Lynch and how great track records are usually built on a few good calls. I always remember Ben Graham, who wrote the original version of Intelligent Investor, and he said if it wasn't for Geico, which is an insurance business that Warren Buffett owns these days, if it wasn't for that great growth stock, you know, over 50 years, he said no one would have heard of him. He made more money out of that one growth stock than he did out of all his cigar butt investing through his whole career. What's left? One idea, just as a general theme, which we haven't really applied too much yet, but I do want to over time, and that is, if you look at the areas of the market that are the least competitive and where you're most likely to find a bargain, it's in the small cap area, and that's just as true in Australia as it is anywhere else. But the difference in America is a small cap can be up to 8 billion Australian dollars. So that's clearly a mid cap in Australia, whereas a small cap in Australia is usually nothing more than $1 billion. And the quality, apples to apples, from comparing an $8 billion business to a $500 million business can often be chalk and cheese. So I think there's a real sweet spot for finding those big winners of the next 2 decades at that sort of 5 billion, you know, 1 to 5 billion US range, where they've sewn up their market, they're clearly very profitable, great balance sheets, hopefully the founder's still in charge, and they've still got decades of growth in front of them. That's what, you know, that's what I'm personally really looking for. So I think that's everything for me. So I'm going to hand over to Nick, who can give you the investment case for a few stocks, and then we'll get stuck into the Q&A.
Yeah, and I was just going to say that don't worry, that I can see all the questions that are coming in, and I'm just going to hold them for the very end. Sorry, Nick.
No, you're right. Thank you. Yeah, so MasterCard, as Nathan's already said, it's a fabulous business, perhaps one of the best businesses on earth alongside Visa. So they share a duopoly with Visa. Together they own the rails of the financial system. So every time one of MasterCard's 3 billion, you know, credit cards or debit cards is tapped, they take a small fee. and it's an incredibly entrenched competitive position. So even Apple Pay, who operate the wallet on your phone, they chose to partner with MasterCard rather than compete, because they're available or they're accepted at 80 million merchants around the globe. That's a tall proposition to meet. Apple Pay would have to go out and sign up merchant by merchant, and it would be an inferior proposition to just your regular bank card. So for that reason, most potential competitors choose to partner with these two payment processors. The biggest growth driver for MasterCard, as it has been for the last 40 years, will be the transition from cash to card. It's still going on. So in Australia, 10% of transactions are completed in cash, but around the world, it's over half. So countries like Germany and Japan, as well as emerging markets, still transact a lot in cash. And that's been encouraged by governments to switch over to card to avoid tax evasion, money laundering, and also to encourage financial inclusion. So that's a huge growth driver. It's over $20 trillion worth of payment volumes. So that alone can double MasterCard's business. That's without growth in nominal GDP and growth in just general consumer transactions. And without even looking at their government payments business or business payments business, which is another $80 trillion worth of payment flow. So despite it being a $350 billion business, we don't think the growth's over. In fact, we think they can grow earnings at mid double digits in terms of earnings per share for a number of years to come. So at around 30 times earnings, we still consider MasterCard to be not quite a bargain, but a fair price for an unbelievable business with a great growth prospects moving forward, and something we can't find in Australia either, let alone the quality, just the growth for a business of this size.
If we use CSL as sort of our pin-up stock for Australia, for the company that can't do no wrong, or can do no wrong, MasterCard has net profit margins that are twice what CSL produces. And MasterCard doesn't have to spend billions in research and development to develop new products over the next decades, otherwise its earnings will fall. So, as much as CSL is a great business in Australia, we've got a business here that's growing much faster than the underlying growth rates at CSL, maybe not for the next year or so where earnings are recovering after COVID. But over the long term, we expect MasterCard to grow much faster than CSL, and it's trading cheaper. And in my view, it's a much better business, which is a pretty big thing to say. One thing I'll just say quickly, MasterCard is, in terms of difference with Visa, MasterCard gets about 2/3 of its revenue, if I'm right, Nick, from outside of America, whereas Visa is the opposite. And so it actually gives you a true global exposure. And one thing that always makes me laugh is the people that always say, I'm not going to buy an overseas stock until the Aussie dollar gets to 80 cents. Yet they're more than happy to pay huge premiums for CSL and ResMed and all these great companies, even though most of their money comes from America. So it's interesting how people have these entrenched views that don't really hold water.
Yes, the next one, Floor and Decor, they're not a global business, they're an American business. So they're a home improvement retailer that specialises in flooring. And their main customer proposition is they operate warehouse-like stores that are about the size of a Bunnings. So they can skip over the middleman, go directly to suppliers, and then pass that savings on to customers. So for specialty flooring competitors, it's just no match. They just can't match those prices. For the bigger guys, Home Depot and Lowe's, that can match prices, they can't match the product selection that this company has. So these guys stock 2,300 hard flooring products, whereas Home Depot and Lowe's, because they have to have gardening products, paint, you name it, can only stock 400 or 500 flooring products. So if you're looking to renovate your bathroom, you want to go to the shop that has the lowest prices, but also the most product range, and the one with a bigger in-stock position. And that in the US, that's Floor and Decor. The growth driver for them will be rolling out more stores. So they brought in Tom Taylor in 2012, and at that point they had 20 stores. That's now up to 190 stores, and the goal is to get it to 500 stores by the end of the decade. And we're really backing him to execute this. We think he's the right man for the job. He started at Home Depot when he was 16 years old, and that was in their 6th store. He quickly rose up to be the youngest store manager in Home Depot history. And then he went on to become the vice president of merchandising. At this point, Home Depot had 1,500 stores. So he's seen what a successful store rollout looks like, and he knows what to do. And there's plenty of opportunities for him to go after. Just two quick examples would be Minneapolis, a market the size of Melbourne, has one store, but that's a market that could easily fit 4 or 5. New York City, a market triple the size of Miami, only has half the stores of Miami. So there's plenty of growth here for him to exploit. The other main driver for them will be their existing store footprint. So a mature store, which is one that's 5 years old, is twice as profitable as a new store. And 70% of stores are yet to hit that mark. So that'll be another nice kicker to profits. On top of all that, there's this massive growth tailwind coming from the industry itself.
Yep.
So I'll just finish off floor and decor until Nick comes back. And so basically, I think he was talking about the maturation of the stores. And at the moment, the company calls a mature store a store that they've had for over 5 years. And only 30% of the 190 odd stores that it's got so far are in that bracket. So you look at this price to earnings ratio in the low 30s, and you go, it's quite high. But if you actually work through even just the existing store base, if it gets up to those profitability metrics that we expect of a mature store, then that price to earnings ratio is going to come down very quickly, even just with the stores it's got, yet alone with all the stores we're expecting it to open over the rest of the decade. And the only one of, I guess, probably the most well-known similar type rollout in Australia at the moment is Lovisa. But maybe I'll eat these words for different reasons at some point. But the difference between the two, to me, is that this business model is one that I can imagine, essentially being in the economy forever. Like people, flooring is just becoming a much more important point, differential point in people's homes, and people are willing to spend more and more money on flooring than they ever have before, which is great for the margins for floor and decor. But with Lovisa, I feel like, yes, maybe it will open up, all these massive new amount of stores that the new CEO is getting paid an absolute fortune to open. But I just don't know about the longevity of that business model. I just don't know. I just can imagine floor and decor being around for the next 50 years. I can't imagine Lovisa being around for the next 50 years. So to me, this is a far better option. And who knows how it will turn out. But I think this is one of the, for me personally, is easily one of the most interesting ideas that Nick's brought along.
Did you get your voice back, Nick?
Yeah, sorry about that, guys. I don't know exactly where I cut out.
I was going to
jump onto Ferguson, mate.
Sounds good. So Ferguson is another North American business. They're a distributor focusing on plumbing supplies, building materials, heating and cooling solutions. They're most similar to Reece, but that probably undersells Ferguson a bit. They have a much wider product breadth. They're the number 1 or number 2 player in most of the products they distribute, and that gives them an incredible advantage. So in distribution, having a fragmented buyer and fragmented supplier base really matters, and that's what Ferguson has here. They've got 34,000 suppliers, and they provide those items to over 1 million customers through a network of 1,600 stores. That compares to Reece that have just 200 stores. So this means that they can deliver products quicker to the market, and so the delivery times are much shorter. And in this industry, that matters. So when a tap bursts or a pipe bursts, the customer needs to fix that as soon as possible. So professionals tend to go with the scale provider and the one that has the shortest delivery times. And in the American market, that's Ferguson. Yet still the market is pretty fragmented. So Ferguson had 2% market share or 3% market share a decade ago, and now they've got around 10% market share. But this is a market 10 times the size of Australia. So there's still plenty of growth to go after. Management thinks they can grow revenue at high single digits. They've repaired the balance sheet incredibly. They earned 44% return on equity last year, and now they're distributing that to shareholders through share buybacks and dividends. So it's a business that can perhaps grow earnings per share around that mid double digits, and it trades at 15 times earnings compared to Reece for probably similar growth at 27 times earnings. And again, I'd stress the quality of the Ferguson business compared to the quality of the American business is probably higher.
I think you might have mentioned these before, Nick, but there's a big theme in the US that I've talked about from time to time, and that is that the current population cohort of people sort of around 22 to 35, 40 is the biggest population cohort in America's history. So unlike other parts of the world, like China, for example, where they've got a potential declining population, a really aging population, what we sort of have here, it's very different in America. And so these are people who are going to want to buy homes, who want to start families. And I think the average age of a home in America is about 39 years. There is a shortage of homes in America. The new home builds have just been well under average ever since the GFC, and they haven't caught up. And here you've got this rapidly growing population. So you've got these nice tailwinds behind these businesses. And, one thing that people don't understand about American mortgages is that the reason higher interest rates haven't had much impact in America yet is because people have fixed mortgages. So if you've locked in 3%, a year or two ago, that's yours for as long as of the life that you have the loan in that home you live in. Once you move out of that house, you have to get a new loan and then pay the higher rate. But if you think about what that means, like the home market has just come to a standstill because no one wants to move. And you can imagine that if you're stuck in that house for a long time, you're probably more likely to repair it and upgrade it and make it better rather than double the cost of your mortgage repayments and move to a new place. So that's absolutely perfect for companies like Ferguson and Floor and Decor. But the thing that matters is always the individual company and the valuation and the competitive advantages and management, all those things. But it's really nice to have those great tailwinds actually blowing very rapidly behind you rather than in your face where you see, I know I keep picking on the banks, but banks in Australia, it's really hard for them to grow. They're just so mature, they're so big and so dominant. And Australia's a small country. There's only so much money we can borrow. So for people listening or anyone else who is downloading these slides later, I've included a couple of other stock ideas, but we talked about these in an article leading up to today's webinar. I also included a few stocks, but they're just old slides that anyone who's followed our old webinars will have seen before. It's just a few of the small caps that we expect to be in the fund that we've owned for a while and expect to own for a long time. Just in terms of some basic things about the funds for anyone who's not familiar with our funds, because basically this applies to all our funds. This isn't a listed investment company. This is a listed ETF, so you can't buy at a discount or pay a premium, thankfully. You get net asset value. One thing that's really important is that we are the market maker, and if you look at the amount of units traded on per day, there's not very many, and people seem to think that means the actual fund is illiquid, and that's not the case. The fund is extremely liquid. I haven't worked out what the average market cap of the stocks in this fund is going to be, but it's going to be huge. So there's no liquidity issues. It's with a listed ETF, the amount of units that trade on a daily basis just reflects the supply and demand for investment in the fund, not liquidity. Obviously, it's a ready-made portfolio, and we've talked about how we can hedge the currency. Same intelligent investor long-term approach, which is our edge. Focus on high-quality businesses, long-term holdings to minimise your tax, semi-annual distributions. Obviously, there won't be much in the way of franking credits in this fund. There will be some, but not many, and that's not really what we're in this fund for. If you want franking credits, then obviously we've got an income fund for that, and three Australian funds. Same regular reporting and candid communication, but I think it's a hallmark of intelligent investor, which is what made John Addis start the business incredibly almost 25 years ago. And I've talked about the fees. So that's basically it for the fund. Now we can do the Q&A.
Fantastic. There is a ton of questions here. I'll quickly just run through some questions that cover of admin and give you both a break with your voices. So remember that the initial offer period opened. It opened on the Monday, and it's going to be running until the 24th of March, which is the next Friday. So that's when the initial offer period is there, and that gives you the ability to purchase units, and they'll list at $2.50 on Friday, 31 March. Some people are asking, what's the advantage of actually doing this initial offer? Why can't I just go ahead and buy them on market? They're actually not listed on the ASX yet, so you can't go and buy them on the ASX. You have to wait until the 31st. And on that day, they might go up in value, they might go down. With this initial offer, you're not paying any brokerage as well, and you're not paying any spread. So you're not paying that extra 1 cent aside of the listing price. So there's some of the advantages of getting into the IISV now. Nathan, there was some questions here about the team, talking about now that you've got international focus, international exposure, is that going to slow down your team in other areas? Is there enough time to cover everything? And is Nick going to just focus on international stocks himself?
So no, he's not. He's still covering Australian stocks. So I think there is a concern from II members in our subscription business that we're taking on too much. But we've been working on this for 8 months and no one's noticed any difference. The only difference moving forward is that Nick's actually going to be publishing articles. But we don't want to overwhelm people, so we'll just aim to do 1 overseas article per week. So it's not overly taxing on the team. What it's going to stop us doing is recommending rubbish on the Australian market. And instead, it's much better that we recommend a high quality business that people can actually feel confident putting a meaningful amount of their own portfolio in, hopefully for the next 10 or 20 years. And that's what I really want from this whole process of starting this fund and covering the international stocks in the subscription business. Is I want people to feel comfortable about starting their international journey, and I'm absolutely positive that even people who have no interest today, if they just keep reading the article each week, eventually they're going to find something that they like. And if they just find one idea out of it and it makes them a lot of money, then it's worth it. So that's really the plan. It doesn't impact the team. The team is very different. It's funny enough, it's the same team we've had for a very long time, but the individual investors have grown a lot over the last 10 years, and they actually just keep running into these overseas stocks as part of doing their own research for the Australian stocks. So it's not actually any more work other than Nick having to write all these articles. It's actually, we're doing the work already, but we're just sharing it with investors.
And that's the other thing, I guess, that's exciting about this, is that you're going to start talking more about it in the subscription service. So there's no price increase based on that. They got all the regular subscribers are going to now get international stock recommendations and research.
It's funny, basically we're giving it for free and still got lots of complaints. Some people are never satisfied. But I just think it's such a better, use of our time to be focusing on, a quality bunch. This is all about quality, not quantity. We're not filling up the fund with 70 stocks and then all of a sudden Nick's got to cover 70 stocks in the newsletter. That's not what this is. This is by 25, 20 odd great overseas businesses shared around the team. Obviously Nick's going to be the one mostly writing them up, but the rest of the team has done work as well. And it's very, very easily covered with our existing resources. And I think it's a great use of our time. I think the team's a bit rejuvenated going through it. Instead of feeling forced to be looking at these low quality stocks and feeling the pressure of having to keep coming up with ideas. It's really tough, especially as the market got really expensive in 2001. It's the same with every cycle. And as always, we recommend a bunch of speculative stuff and told people, only buy 1 or 2 and only in 1 or 2%, and they all blew up. And you go, okay, you reform and go back to, swear on the Bible, we're only going to look at quality. And if nothing else, just all of us listening as individual investors, there's always something to learn about learning about new businesses. And that's what really set me off on this. Back in 2006, I joined Intelligent Investor and I just wanted to be the best possible analyst that I could possibly be. And to me, I was working really hard. I was working 7 days a week. Every minute I was reading books, covering my Aussie stocks during the week, and then looking at overseas stocks on the weekends and at nights. So really, this fund is, I say it's been over 10 years in the making, but it's really, takes in all the experience I've had over all the years and all the experience of the team and now Nick. So, the team we've got at the moment is the best team we've had in a long time. I'm really excited and, don't want to blow smoke up Nick's backside. He's still got plenty to learn and plenty of work to do. But when we get new people like Nick on the team, it rejuvenates everyone, and it's just been really enjoyable. And I'm just, that focus on quality is just so much less stressful for everyone in the business working on stocks than it is when you feel there's so much pressure to come up with the latest idea in Australia. And people have said they want us focused on Australia and they want more stocks from Australia, and I'm telling them that we need less. You know, there are only so many good businesses in Australia, and every time we veer off them, we make mistakes and people lose money. So this will help stop that too.
And Nick, is it sort of still focusing, like it's a question here from Jay just saying, is it still focusing on the top 20 companies? But that's not the case, is it? Like Nathan's just mentioned how it's opened up an entire range of US shares, overseas shares that we can look at now?
Yeah, absolutely. And as Nathan said, I mean, the focus for us is quality, and we can now go over to the US and also some European countries, but the focus is the US, and find the highest quality businesses and stocks that we're also familiar with their business models. I mean, one example is CME Group, which is the world's largest futures exchange. Compared to the ASX trades at 25, 26 times. It's grown its earnings per share at 3% per year for the last decade, and this business has grown at 10% earnings per share for the last decade, and it's probably arguably a better business. I mean, it has a monopoly position trading US interest rates, and that's available at 20 times earnings. So there's a number of opportunities over there to look at, and yeah, I'm really excited.
I was going to ask as well, is the process still the same as the existing stock coverage where you as an analyst have to present it to the rest of the team in a Dragon's Den type approach where you're criticized and critiqued and broken, not broken down, but taken apart in terms of why you think it should be in the fund or recommended?
The answer is most definitely, and Gaurav's actually just written a little article that once we've got this webinar up on the website and we've got a link, Gaurav's just got a little missive with a link to the webinar, and just explains why he's investing in the fund. So he's been a real convert who had no interest investing his own money at the start, and then as Nick's week in, week out been providing all the research on all these new stocks, it's got him so excited he's actually putting his own money in the fund. So again, a nice feather in the cap for Nick, but it just shows the potential in these companies. It's yeah, just something for people who are sort of investing nerds. I think Chris Mayer is the name or something like that. Wrote called like 100 Baggers or something, and something. This book is often ridiculed for how simple it is, but what he's talking about is right. It's trying to find businesses, and this is what Buffett's been on about forever. Is just finding these rare, great businesses that you can hold for decades, and never wanting to sell. You know, things like Costco that's made Berkshire rich, but also Buffett's offsider and Charlie Munger. He talks about Costco all the time. You know, just these wonderful businesses, and it's just so reassuring when you're looking at these businesses compared to looking at some of the low quality stuff you feel you have to cover in Australia. And you know, people asking for your opinion on the banks all the time, and we've got nothing. We've written so much on the banks. You know, I used to cover them years ago, and there's just nothing new to say, and there's just nothing new about those businesses. And we know the returns are going to be poor. They've been poor for a long time, and they're going to continue to be poor because the return on equity has just got worse and worse. And so one of the key things we look for is we want businesses with expanding moats or expanding competitive advantages that are getting bigger and better every year, not shrinking. And that's the real risk when Woolies is a classic. I mean, you pay what, 24 times earnings for Woolies at the moment? Like, it's hardly growing. Great business, but like, how many more Woolworths stores do we need? You just, it's not the company's fault. But I just feel like a portfolio of, you don't have to be stuck with a portfolio of businesses that are cyclical and come with just a bigger world out there. But I think people have been waiting for someone to hold their hand and guide them through it as simply, as easily, and as stress-free as possible. And that's what's behind this whole process. I want it to be simple. I want it to be easy. And I don't want to be mucking around with speculative stuff. I just want this to be all focused on quality, because if people aren't willing to put meaningful amounts of their money in these stocks, then it's clearly because we've picked the wrong stocks. The quality is just so much better abroad, and that's what we want to bring to our investors.
There's a couple of questions here about dividends, distributions, and we're hoping to pay a half-yearly distribution, so twice a year, but that's always up to the actual fund manager themselves if they go ahead and do it. You spoke about there's 70% around about international stocks and 30% in Australia, so the franking isn't going to be too big. Dividend reinvestment will of course be an option which you'll do through the share registry or perhaps through your broker once you hold the stocks. Do you have much more information about the income side of this fund?
Well, the thing is, this is and obviously, if you make, in fact, probably none that actually pay dividends as high as what we do in Australia, maybe in the UK, it might. And very few other countries actually have a franking system. It's very rare in Australia. So obviously you need to keep that in your returns, but to ideas like I talked about with Celsius, where you know, if I had have held on to the top, you know, obviously that's not, you know, unrealistic sometimes. But you know, you made you know, what was it, like 30 times your money. A business that a bunch of fund managers had identified. You know, I guess it's sort of obscure stock, but it was one that was certainly well known enough and was getting enough publicity. So when you think about those opportunities, it's just like, who cares about the dividends? Who cares about the exchange rate? You know, just focus on these underlying opportunities. And I think that's what most people miss when they start making excuses about currency rates and things. And, you know, if you're an individual and you're in money and making these investments, then, you know, you sort of have to be aware of it. But again, we're investing mostly in the States. We're not going to obscure countries where you really do have to worry about the currency. You know, for anyone that knows about Frontier, you know, obviously if you've got assets in Pakistan, you really do have to worry about the currency and incorporate that into your valuation. But it's just much less of a concern. We're hedging the currency anyway. And I think if you're just focusing on the currency, then to me, I just think that's excuse for not wanting to invest overseas. And you don't have to. No one's forcing you to. That's absolutely fine. If you like your Aussie stocks and you're doing great, and maybe you get a bit of razzle dazzle from some small caps in Australia or whatever to juice your returns, you know, great, absolutely. But if you're looking to own the best of the best and you want to really be doing it, that helps you sleep at night, so you can go to bed every night knowing that while you're asleep, all these wonderful businesses and their managers and staff are all working their backsides off to create a bigger and better business over the next 20 years, then this is what the fund is. That's why we created it.
And in terms of obviously investing in US companies, do you know much if there's going to be much paperwork that has to be done by investors, like the W8BEN forms, things like that?
Yeah. Like that used to be a nightmare. That's absolutely true, but it's not anymore because you know, I like use Interactive Brokers, and on there, it's all digital now. And you just sign the form. Like it's no big deal at all. Everything's digitized these days. So all those previous complaints, you know, there is always going to be some paperwork involved because, you know, you're not, a foreign country isn't just going to give anyone a license to buy stocks, you know, without filling out appropriate paperwork. But it is all automated these days and much easier than it used to be.
There's a couple of questions here about, I guess, the current market conditions, and even talking about interest rates rising over in the US and Australia. Is a good time to be buying stocks? Is there a way in which you will like deploy the funds that you've raised so far? Do you have to sit there and take all of that into account and think? I mean, I know if you hesitate too much, if you you know, wait too much, you're going to miss opportunities, and that's not what your team does, is it?
Yeah, so this is why we've waited till now to launch the fund, and why we didn't do it a year or two ago, because the valuations were just ridiculous. So now, obviously, there's a lot more reality priced into stocks, so that's been great. That's part of the reason why we're launching now and not earlier. In terms of, it's funny, the portfolio that Nick and I talked about in November is vastly different to the portfolio that we're talking about today. This is share prices have moved so much recently for a lot of the stocks. I mean, some of the stocks that Nick liked in particular have gone up 30 or 40% since then, and fortunately now they're coming back down again, which is awesome. So in terms of investing the fund in a couple of weeks, once we've got the money, you know, in terms of whether we'll hold a bit of cash to start with, I'm not really sure yet. Stock prices are bouncing around so much. You know, part of me just wants to invest the whole lot and get it done and get on with life. And there's another part of me that thinks there's bound to be a few extra opportunities later in the year, and maybe it's worth just holding a little bit of cash for those rather than having to maybe sell something later and then buy something new. So I haven't fully made my decision about that. We'll make that decision once we've got the cash, but you know, all that stuff is just short-term stuff and isn't really going to matter in the long run.
Yeah. There's a few questions too, just about how to apply, who can apply. If you are from overseas, New Zealand or even the US, there's a couple of questions. As long as you've got an Australian share trading account with a HIN number, a holder identification number, then you can actually use our online platform and type in that HIN number and it'll get directly assigned to your share trading account. And that goes for even Australians. If you're applying for this initial offer for units in IISV, the best way to do it is using your HIN number, because once we allocate you the units, it'll go straightly to your share trading account. Otherwise, if you don't have a share trading account, you'll use, we'll actually send it to the registry, which is Link Market Services, and then it'll be up to you to register those and do all the admin from that end. On the website, you can apply in, personal, so an individual, joint, SMSF, so self-managed super funds. You can pick a number of different account types when you apply. And as long as you've got a HIN number set up, you can send it straight to that. So the super funds HIN number, the one that you manage yourself, or otherwise we'll send it to the share registry for you. I'll just have a look if there's some other questions. The other question that we had around is liquidity. And I know you did cover this off talking about how we use a market maker. So they are literally sitting on the buy and sell price. They're making sure that they're 1 cent either of the net asset value. So it doesn't trade at a premium, doesn't trade at a discount. And it means that once it's listed, if you're someone that wants to exit your holding, even though it's a long-term investment, keep that in mind. You won't have problems during the trading hours. I'll just minimum investment. A lot of these details are all on the offer page, which I've put into the group chat there. The minimum investment for the initial offer is $2,500. There's some questions around the fees. So a few people still just wanting a bit more information about the performance fee, but we should note that there's the standard 0.97% per annum management fee. There are some transaction fees. They're estimated to be around 0.14% per annum, but they're variable. And then there's the performance fee of 15%. And a lot of this information is detailed in the product disclosure statement, so definitely read that. But can I give you an example, Nathan? It's you're put your accountant hat back on. There's a question from Peter. If the cash rate is minus 0.5%, and you achieve a 1.5% return, can you get a performance fee on that 2% outperformance?
Yeah, I guess so. I don't think the RBA cash rate's going to negative 0.5%, so I don't think we need to worry about that.
Yep. I mean, that's also, you've got to still beat that high watermark too.
We've got to make people money. That's the whole point of that there. We've actually got to make people money, and obviously there's an assumption that the cash rate is going to be positive. But we're talking, it really is a no BS performance fee. If you want to see what a rotten performance fee looks like, I talked about funds with no high watermarks. That's probably the most egregious. There's a hedge fund out there I know that has a RBA cash rate plus maybe a small margin as its hurdle, and it gets all its bonus fees based on that, even though it's a fund full of stocks, long and short. That's an egregious performance fee. This is not that. We're going to have to work very hard to earn a performance fee, and if we earn it, people are going to be delighted. So don't get too bogged down in crazy scenarios like that. It's very simple, and no one in InvestSMART is getting rich because of this performance.
The other thing, and this is something I find interesting as well, is so the fund trades on the ASX. It has a ticker code of IISV, so you can buy it through Australian trading hours or obviously through this initial offer. But you're going to hold some stocks. Are they held in trust? And how does it actually work? Because they have different trading hours. Do you just take the last traded price and then hold on to that?
That's a good question. You probably need Mitch to get on there to talk about all this stuff, or Alistair. But at the close, but we've got all the administration team working with our brokers and a whole bunch of service providers to work all that stuff out. And obviously we have to work that stuff out for our subscription business as well, because correct prices on there, and we have to pay for prices and a whole bunch of other stuff. So it's not necessarily a cheap undertaking. But if you need more detailed stuff on that, then send us in the question of what you want to know, and we'll pass it on to Alistair, who knows that stuff better than I do.
Yeah, absolutely. And we'll try and keep adding to the help center, which the link was also put into the group chat. There's always different questions that we get, so we always try and put that in there. The other thing is there's a lot of people asking questions. If you're someone who's invested in an InvestSMART professionally managed account, as you know, you can actually hold some of the intelligent investor ETFs inside there. And that's going to be the same thing with the IISV. So after the listing date, after the 31 March, you'll be able to put that alongside your other portfolios inside the InvestSMART PMAs. And of course, the intelligent investor, they're actively managed investments, and they charge a 0.97% per annum fee. There's the performance fee as well, whereas the InvestSMART products are passive. They use products like BlackRock ETFs, and they have a capped fee. So definitely have a look at that. We've written a lot about different strategies, core and satellite, how actively managed investments like the intelligent investor funds could be appropriate for you. So definitely look into that. I'll just see if we've got any more questions here. There's a lot that they seem to group all together. And there's a lot of questions still coming in about whether people will get overlap with their ethical share fund, the growth fund, and whether or not there's some people talking about how the recent performance of some of the other funds hasn't been the best, and whether they should look at moving away from that and moving to this. And I know it ventures into personal advice, but do you have any thoughts on that?
There's very other funds, so that's the number one thing. In terms of the performance of the other funds, you can't be winning all the time, unfortunately, and out of favour at the moment. I think one of the areas in the Aussie market where there is actually genuine value is the small cap area, but we're limited in terms of how many of those we can buy. But they're the ones that are mostly getting hurt. Obviously, Star Entertainment, not the ethical. I saw one question, and I'm sorry, but I have to pick on it because, you know, we really want long-term investors in this fund. If you don't really understand what we're about, what long-term investing is about, like, please don't give us your money. We just don't want it. We understand what we're about, how hard investing is, that you can't be winning all the time, and that the price to pay for high long-term returns is poor short-term returns. That's just how markets work. If you want to outperform, you've got to do something different, and that means you're not going to be winning all the time. So I think we've done an extraordinary job in the recent couple of years in the funds. And I know there was one person complaining about they've lost a little bit of money in the ethical fund, and yet the ethical fund's done over 3% a year better than the index after fees. And if it was allowed to invest in the resources companies that we bought in our other funds, it would be 30% ahead of the index in less than 4 years. You know, and someone's complaining about that. It's just, I'm afraid we're not miracle workers. We're just investors. And if you invest for long enough, then we've shown over the last 24 years that value investing works. And I'm extremely proud of our track record. The income fund, you know, people who've been in it but don't remember, when I first got back to Intelligent Investor, within a few months, that fund was like a grenade going up in my face. You know, and it was got 26% behind the index in 3 months at the start of 2019. And I was just like, oh man, like, am I going to fix this? Because I hadn't been looking at Aussie stocks for 3 years, so it was going to take me 12 months to get my head around it over all the stocks again. And you know, here we are, and we've made all that up. You know, like, it's just been an incredible period. So unfortunately, we're always going to have that period in the track record, which is unfortunate, because I really think that income fund for the stocks that have been picked since then, you know, really should be 3% ahead of the index. But to have 3 funds where the income fund, from what I can see, is the single best performing fund, income fund in the country since we started managing money in 2015. You'll notice on the website it's only equal with the index because that's since we launched the ETF. But if you include the year or two before, where we had the PMAs, it's the only income fund I can see beating the index. and I mean genuinely beating the index, not putting franking credits in to boost the, the income, or using a stupid benchmark like the RBA cash rate or something like that. It's genuinely beating the market. The growth is going really well. Obviously not great at the moment, but as I said, you can't be winning every single month. And the ethical fund, if it was allowed to invest in resources stocks, would be 6% ahead of the index or more a year, and phenomenal. And it's no wonder it was rated number one in its category by Morningstar. So if you're complaining about those returns, please don't give us money for this fund, because investors, we're not miracle workers, and we want people who are in this for the long term and understand how difficult it is. And I don't want anything about this presentation to make anyone think that investing abroad is any easier than it is in Australia. But there are a whole bunch of tailwinds of doing it that should, in theory, really suit our investment style.
And just to reiterate on that long-term approach, we do have on the offer page a target market determination. So you should definitely read that as well, just to see if this is appropriate for you. It's long-term, isn't it, Nathan, in terms of its, a suggested time frame of 5 to 7 years from memory?
Yeah, absolutely. I mean, particularly with currency, I've talked about how you need to focus on the stocks and opportunities rather than the currency. But if you're thinking about pulling your money out in, who knows, 2 years, 3 years, whatever, then the currency could potentially matter, because who knows, maybe the Aussie dollar rallies to like a parity with the US dollar, and all of a sudden you want to take your money out. But the longer you invest for, then the less the currency becomes an issue, because over the long term, the currency fluctuations just wash out. So again, this is only a fund for genuine long-term investors. And if you've got any other thought, look for a different fund, not this one.
Fantastic. We've definitely run over time here, and we have had a lot of questions that have come through. We've actually covered off most of them. I guess different ways to ask the questions, and there's any we haven't covered, we'll actually go through and try and put them into the help center as well. The thing is, all the information, as we've been mentioning, a lot of it's on the offer page where you can apply for this initial offer. Talking about the key dates, so the offer closes Friday, 24th of March at 5 p.m. Sydney, Melbourne time. So if you do apply, you'll be given a BPay number, a reference and a biller code that you need to make payment by. So don't leave it to the last minute in case your bank has different restrictions on the amount that you can spend or send, I should say, because you can, or you might want to send it over a couple of days sometimes. So don't leave it to the last second, or you will miss out. If you've got a holder identification number, definitely provide that during the application. We'll send it straight to your share trading account. It's the quickest, easiest way. Is there anything else you wanted to add, Nick or Nathan, before we wrap it up?
There's nothing for me. I just thanks as always, Tom, for doing this for us, and thanks Nick for not just for today, but for all his hard work since he's joined us. And a special thanks to everyone listening. And even if you have no interest in the fund or in international coverage or anything, but you're still with us after all these years doing what we're doing, we'll keep it going. And thanks very much.
Yeah, thanks everyone. And just a full disclosure, I'll be investing behind the fund. Can't wait. I'm extremely excited, and looking forward to hopefully getting some good long-term performance with some high-quality businesses.
The best thing about Nick is he knows he's got the best job in the world, and I'd swap him any day.
Don't tell everyone.
Well, fantastic. Thank you both as well. And thanks for explaining everything. I'll get a version of this up onto the website, and we'll email out a link so you can watch it. But if you needed to ask us any questions, definitely check out the Help Center on the offer page, or you can contact us as well via email, or you can give our team a call. But thanks so much, and we look forward to the next webinar. Bye.